of Business 7, Accounting for Small Business. This is the last chapter in which we will cover the last steps of the accounting cycle for a simple service sole proprietorship. Starting chapter 7, we will talk about the merchandising business, and our accounting system will include new accounts such as merchandise inventory, and it will become a little bit more complex. So again, in this chapter, we're gonna pretty much talk about closing entries, the last 4 journal entries, and also the last the last accounting report called the post-closing trial balance. And then we will talk about the interpretation of the financial statements. So the first objective is to explain the function of closing entries. As I mentioned, we are going to cover the last 3 steps of the accounting cycle. Right now, I want to focus on the 7 steps: journalize and post closing entries. But before we start journalizing closing entries, I want to explain why do we do them. So if you have your own business, you of course want to measure if you're profitable or not every period. So your net income or net loss should be measured every accounting period, which for a small business is every month. So in order to do that, I need to begin every month with zero, with my revenues and expenses having a zero balance. And I also want you to recall chapter 3 when we separated permanent accounts and temporary accounts. So the last 3 accounts, RED, revenues, expenses, and drawing, they really belong to capital. They are part of the owner's equity umbrella. And we separated them because we needed to look at changes in capital and we needed to calculate net income or net loss. Well, right now they need to go back home. I'm going to eliminate these temporary accounts. So one of the 2 goals for closing entries is to zero out, to bring these 3 groups of accounts to 0. And what we're going to do, we're going to take them and we're going to move them into capital. Eventually, all of those accounts, because that's where they belong. I want to remind you, drawing and expenses decrease capital, revenues increase capital. So as I mentioned, 2 goals. The first goal, to zero out temporary accounts, and the second goal is to update the capital account. So the 4 steps of the closing process, before I list the 4 steps, I want to introduce this new account. It's called income summary. Do not confuse with income statement. Income summary is a strange account. I think of it as a trash can. I use it for a couple of seconds. I use it for less than a day. I'm going to transfer revenues and expenses, throw them out into this account. Throw them into this account. That's why I call it trash can. And then I will not need this account anymore. So it's classified as a temporary owner's equity account. We're going to use it for a second and then we're going to close it to 0. We're going to close it into capital and make this account to have balance 0. It's used only in the closing process to summarize the results of operations. That's why we call it income summary. And it's the first account which you see as an account without a normal balance. Of course, it has a debit, it has a credit, so the left side is debit, right? The right side is credit, but it doesn't have plus minus or minus plus, which means the balance could be on any side. If I have a balance on the debit side, if I end up having a debit balance, that means we have net loss. And the way I remember it, net loss means to me that expenses are higher than revenues, right? And expenses have a normal debit balance. So if my income summary has a debit balance, that means expenses are higher than revenues. If I have a credit balance, then it means we are in the black. We have net income. And again, the way I remember it is net income means that revenues are higher than expenses, and revenues have a normal credit balance. Okay, so these are the 4 steps in the closing process. First, we're going to close revenues into income summary. Second, and let me put right here, let me open all 4 steps. So the first step is R, close revenues. The second step is E, close expenses into income summary. The third step is close I, income summary into capital. And the last step is close drawing into capital, REID. So let's actually go through the mechanics of closing entries. I actually like to use I like to use the adjusted trial balance instead of income statement balance sheet because it has all balances. So let me make it a different color. Let me make it magenta. Okay, so find drawing and put a line above. Draw a line above drawing. Everything above the line is permanent. So capital account will change. It will not close to zero, but this 100,000 is going to change. Everything below it is a temporary account. We need to zero them out. So the first step, REID, R. Let's close revenues. I have only one revenue account called fees income. How do I zero it out? Well, since it has a normal credit balance, I'm going to offset that balance. I'm going to debit revenue by 47,000 and it will make the balance to go down to zero. So fees income, my first closing entry, debit fees income, and after I post it to the ledger, the fees income account will have a zero balance. But if I debit something, I have to credit something. And I don't have anything to credit except for this trash can. So that's why I say I throw revenues into the trash can account so we credit income summary. This is how it looks in the journal. So these are the last journal entries in chapter 5 with journalized adjustments. You do not need to start a new page. All we need to do is skip a line and write down in the middle of the description column closing entries. And then you will list 4 of them. They will all be on the last day of the period. You just skip a line between those transactions. And since you write closing entries at the top, you do not need to write descriptions because these are also internal transactions, just like adjusting entries were internal, meaning they are happening within the company. We're taking care of our records. There are no source documents to refer to. Okay, second step, E. Let's close all expenses into income summary. You will usually have more than one expense, so your second closing entry will be a compound entry. So we have 1, 2, 3, 4, 5 expenses. They have normal debit balances. So I'm going to offset their balances and credit all of them to make them zero. And then I take the total expenses, which you can look up in your worksheet. It's 13,333, and I'm going to move them into the trash can account, which is income summary. So after my second journal entry, look, it's a compound entry, 1 debit and all credits. So when you list the accounts, I would list credits first, and then you simply add them up and you put the debit for the total expenses. Okay, so now the income summary reflects all entries in the income statement. We have the debit side with the total expenses, we have the credit side with the total revenues, and the balance is on the credit side, and this balance represents net income, right? Hence the name, income summary. Revenues minus expenses give us net income. I don't need this account, so I need to zero it out. I'm going to debit this account by the amount of net income, 33,667. So when I debit income summary, it goes down to zero. And I'm going to move it as a credit into my capital account. And it makes total sense. If I have net income, my capital will go up. So I'm going to put move 33,667, which is the difference between revenues and expenses, net income. And it's going to go to the capital account. By the way, capital account has the beginning balance of 100,000, and we're going to add net income here. So what if I had net loss? Let me use a different pen color. So if I had net loss, let's say I had $10,000 in expenses, and I had $7,000, different example, $7,000 in revenue. So that means I have a debit balance in the income summary account, and my debit balance is 3,000, and that debit balance represents net loss. Net loss. So what do? I'm going to credit now income summary to make it zero, and I'm going to debit capital, and it makes total sense. I debit capital because net loss decreases capital. So depending on net income or net loss, your accounts will be flipped. And guys, the last step, I'm sorry, this is the third step. So the third step, I already went over it, is to close income summary in the capital. And again, as I mentioned, if you have net loss, you just flip those accounts. You debit capital, decrease it, credit income summary. And the last closing entry and the last journal entry for this period, yay, is to close drawing into capital. Drawing has a normal debit balance, so we're gonna credit the drawing account to make it zero, and we're gonna decrease debit capital because drawing decreases our capital account. So debit capital goes down, credit drawing goes down, makes it zero, and this is the last journal transaction. So I would like you to look now at the updated capital. My beginning balance is $100,000. Think of this as your statement of owner's equity. You've already done it on the statement of owner's equity. Beginning balance of capital plus net income less withdrawals equals to ending balance. And this is the ending balance that we already reported on the balance sheet. And this will become my new beginning balance for the next accounting period. So this is a nice summary. First step, close revenues. Second step, close expenses. Third step, close income summary into capital. Could be flipped. This is net income. If I flip the accounts, it will be net loss. If I have net loss, I will flip them, I should say. And the last entry is to close drawing into capital. 4 journal entries. After this, we have to post, well, simultaneously actually, we have to post all of these 4 journal entries into the ledger. And when we post them to the ledger, in the ledger we write closing for the description in the description column. And guys, all of your temporary accounts after closing should show 0, just like this. For revenues, for expenses, for income summary, they will show 0 balances. Before I move to step 8 of the accounting cycle, let me go and show you one example of the problem. So after adjustments, Gonzalez Company ledger contains the following account balances. And again, I look at drawing and I draw the line above drawing. So everything, let me do it this way, everything from drawing down needs to become 0. Those are temporary accounts. And guys, my capital account will change because right here they say it's actually on December 1st. It's the beginning balance. So I already prepared the ledger. So in the first requirement, we're gonna journalize closing entry. In the second one, we're gonna post them to the ledger, and we don't need to do analyze. So let's do journal entries. First step, close revenues. So my revenue account is fees income. I'm just going to look at the balance, which is 148,240, and I'm going to debit this account, 148,240, and I'm going to move it to the income summary account by crediting it. Ta-da! First journal entry. Let me go to the ledger right away and post this. I'm going to post right away. So fees, do you want to say yes? So fees income, what we did, we posted, so you have to write also the word closing. So we debited fees income. It had a credit balance before, so now my balance becomes 148,240. 0. And guys, income summary did not have anything. So right now, with the first entry, we debited income summary by, we credited income summary by 148,240. Ta-da! And that's the new balance. Okay, the second journal entry. So the first one, close revenues. The second journal entry, we need to close expenses. So I'm going to close them into income summary. I will leave debit blank. I don't know what the total is yet. So I have 1, 2, 3, 4, 5 expenses. Let me close all of them. So advertising expense, I'm going to credit by 5,200. And then depreciation expense, I'm going to credit by 940. And then Rent expense, I'm going to credit by 4,000. After this, we have salaries expense, the largest expense usually for a service business. And we have utilities expense, which is a credit of 7120. Add them up, total them up. So I already totaled them up. So my total expenses are 50,060, and that's a debit to income summary. So you let me record this entry and let me go to requirement 2. So I'm going to post income summary, a debit of 50,060. And look what happens. My revenues are higher than my expenses. So what is 98,180? It's actually the amount of net income that I will move to the capital in the next step. And let me go through all of the expenses and let me credit all of them, which will make each of these 5 expenses, it will zero them out. So rent expense credit 4,000, and you can see zero balances in all of them, 32,800. So you can see that closing entries are very mechanical. There is no thinking needed, right? So actually computers program software can do it for you. In adjustments, we have to think. In closing entries, we just follow the template. We follow the steps. Okay? And then the third step, by the way, let me view journal. By the way, guys, so if you just look at the journal without T accounts, I look at the first step minus second step. If the first step is higher, we have net income. If the second step is higher, we have net loss. You subtract right here. You subtract the first step from this, the second step from the first step, expenses from revenues, and that gives you net income or net loss. So let's do the third step. We're gonna record the closing entry for the balance of income summary. So since we have with you net income, I'm going to debit income summary by 98,180, and I'm going to credit the capital account by the same amount. And again, the way I remember it, capital increases with a credit entry. Net income increases capital, so I need to credit capital. Record this entry. Let's go to the ledger and let's close income summary. So we debited income summary by 98,180, makes it 0, perfect. And now capital is increased by the, too much, by the amount of net income. So you can see that the balance of capital went up. All right, and let's journalize the last entry, which is we are going to close drawing into capital. So now capital will be debited because drawing, and my amount of drawing is $7,600 because drawing decreases capital. And I'm going to credit drawing, which will make the account to go down to the balance 0. Record the entry and then go right here. So capital is debited by 7,600. Look at the balance will go down. The beginning balance plus net income minus drawing. This is the balance of capital, which is listed on the balance sheet. And drawing needs to be credited. And now this is the last account that is zeroed out. I took care of all of my temporary accounts, they're all zeros, and moved them into the capital account. Okay, let's finish up this chapter. So the next learning objective, we have to prepare a post-closing trial balance. By the way, this is the third time we're preparing a trial balance in the same date, because we had the unadjusted trial balance, then adjusted trial balance, and now after closing, post-closing. And this is step 8 of the accounting cycle. Prepare a post-closing trial balance. And then we will interpret the financial information. So the post-closing trial balance includes only permanent accounts. The last account is capital. There will be no revenues, expenses, or drawing listed here. So it's just assets, liabilities, and capital with the updated balance. That's it. That's the post-closing trial balance. Nothing should be listed below capital, right? There's no drawing, no fees, income, no expenses. Only permanent accounts appear on this report. Okay, the last step of the accounting cycle is the interpretation of financial statements. We actually will focus quite a lot on the financial statement analysis, which is interpretation in financial accounting. We even have a whole chapter in financial accounting. The last chapter is the financial statement analysis. And we will use horizontal analysis, vertical analysis, and ratios. In this chapter, the interpretation is very much simplified. Financial statements exist to help users make all kinds of decisions. This is the ultimate goal of not just financial statement, but the whole subject of financial accounting is to assist users, especially stockholders and lenders, in making good decisions about the business. And this is some of the simplified questions. Looking at financial statements, I can see what is the cash balance, how much do customers owe to me, how much do I owe to my suppliers, do I have net income or net loss. And so, like, what is the cash balance? You can see it right here. How much money do customers owe me? That's the amount of accounts receivable. How much money do I owe to suppliers? And then you can take it to the next level. You can actually look at cash and look at accounts payable and say, well, is the business solvent? Does it have enough cash to pay for its accounts payable? And that's a little bit deeper analysis, and we can see we have plenty of money to pay for my accounts payable. Or we can take the amount of accounts payable, which is your total liability, and divide it into total liabilities and equity. And you can see that the percentage of liabilities is very small. And if you look at capital and divide it into total liabilities and equity, you see that the capital amount, the percentage will be very high, which shows us that our business is healthy. But again, you will study these ratios formulas in the next level course. Do we have profit or loss? Of course, in this example, we had a profit or income. And so, guys, this concludes our accounting cycle, right? We had all of the 9 steps covered. Now the steps will not change. Starting chapter 7, we will go through these steps kind of again, but we will just use new journal transactions, new accounts. Everything we studied in the first 6 chapters remains true, but we will build upon it. And as I mentioned in my previous video lectures, accounting is a cumulative subject. So we're going to use all the knowledge in the future chapters. And the last slide here, guys, flow of data through a simple accounting system. We have source documents. We use them to analyze business transactions and journalize them. Then we post them to the ledger. Then all the data was moved to the worksheet. And then we prepared financial statements using the amounts from the worksheet. And these are the key terms for chapter 6. Thank you so much. Have fun.